About a month since I did the last portfolio update for the public account. So I think it's time to start to look at the changes, the thesis, if it's still the same. I mean, all of these are long-term holds, so we'll just go through the thesis really quickly for things that haven't changed, and then see what new positions have been added and how much I've allocated toward those and why I chose to buy them. So with that, let's get into this portfolio. Please like and subscribe, and let's see it. So here is the public account. As you can see, the four major stocks that I had before are still the same: Amazon, Meta, Google, and Warrior Met Coal. I still believe in those, and I just have not added to them because they are at a price that I don't want to add at. But I am holding all of these for the long term. So the long-term thesis is still intact for those four, and we'll get into those briefly. I'll go through each one of those quickly since I've already covered it in previous videos. With that, let's start with Amazon. And Amazon is an amazing company. Like I said in a previous video, Amazon's business model is one where they build up the business that they're trying to produce revenue, higher revenues, and net incomes from, and then they translate that free cash flow to, once it's built up, to the next business, and they build that up, and they just keep going over and over and over and over again. So the shareholders and investors will not see they will see huge capex spend and not a lot of cash available from Amazon. But it's misleading because what they're actually doing is taking all of that and reinvesting it into their business or businesses. So it's still a great business. I mean, it's producing enormous amounts of revenue. I think the last, well, let's just look at it. Let's go to Amazon and analyze it with the software. And you can see that I've been doing a lot of work on this software. I'm trying to get it ready for public consumption. It's still in beta and I'm still actively developing it. If you don't know, I'm a software developer by trade, and that's my day job. So I'm doing YouTube as a side hustle for now. So if you want to support me, please, like and subscribe. But I'm building this myself, this software myself, and so I'm trying to get it to a point where it is providing the most value to value investors and my audience as possible. So I need to I'm consolidating all of the data and the trends and everything together to present it in a visually compelling way that actually tells you whether it's a good buy or not. And there'll be other parts of this software that I'm going to build out into the future. This is a single company overview, and you can see even from the last update that I did with the last video, I've added new sections and data trends, visualization trends. You can see like ROIC, return on equity numbers for the past 10 years, and then you can see visual trends over the past few years based on growth, profitability, financial health, dividends, all those things. So you'll see this software change up until I release it for you guys. So looking at Amazon is a unique mega cap tech company. They, like I said, they reinvest most of their money back into their business, and you can see the enormous amounts of revenue. This is what I wanted to show you guys. $638 billion of revenue in 2024. There's very few companies that, I don't even know if, I think this may be the top, that produce that much revenue. Of course, that gets cut down, when it gets down to net income, it gets cut down because they spend so much of it, and there's probably a lot of cost and expenses. Yeah, there's a lot of costs and expenses. in running an asset heavy business, they're a unique combination because they have asset heavy plus, advertising and very high margin, low asset businesses. AWS is just a cash cow kind of thing. So they're generating, a decent amount of free cash flow, even though they're spending a lot in CapEx. So that's why Amazon's so interesting. And when and if they decide to, turn down the CapEx spend and reinvestment into the business, I'm not saying that's a good thing, but when they do decide to do that, their free cash flow is going to explode higher because they make so much money and they're reinvesting so much money. So these numbers will explode higher, and the investors and shareholders will have an immediate benefit when they start doing that, or whenever they start doing that. So that's why I love Amazon, and I think it's an amazing business. They're in so many, like most of these other mega cap tech companies, they're in so many different niches that it's very hard to disrupt them. They're even better than Google in that way because they have, AWS. They're a first mover in AWS with the cloud services. They have the leading e-commerce platform in the world, arguably. They are in a whole bunch of other different sectors. They've recently introduced quantum computing chips, and they're almost everywhere. So it's a great diversified mega cap tech play, if you will. And that leads me to, let's go to Google. So Google is, I didn't add any more shares since the last batch of shares that I bought, bringing my total quantity to about 200 shares. Google has been increasing a lot, and when I was buying it, let's see, I was buying it way cheaper, around once at the highest as 168, but much lower even at 153, 156, 157. Since that time, which was not that long ago, it has gone up to 185 right now. So right now I'm not adding anything to this. Good. We'll look at this on my software. So yeah, just like all the really good companies, revenue trending in the right direction, net income, look at that. Net income is just going straight up to the right. EBITDA, free cash flow. Free cash flow is sitting at 72, almost $73 billion. Compare that to Amazon's, just because Amazon is reinvesting so much. Theirs was like 32 billion, 33 billion. So almost more than double, because, and even though, and Google is also spending on CapEx, but I guess not nearly as much as Amazon is. So they have their expenses, yeah, and they're buying back shares like crazy. EPS is going up. This bar is for incomplete 2025, so don't let that fool you. So full year 2024, 8 is going straight and up to the right. And they pay a dividend, so which is amazing. Another section that I adjusted and changed is this. You won't find a very cheap PE, this cheap a PE for other mega cap tech companies, which is why Google is great, why I still want to own Google. It's not overvalued by any stretch of the imagination. Great numbers. Since it's a profitable company, you always use the PE ratio for profitable companies. Profitable high growth companies, almost always PE ratio for it. And so you can see here, I built this out, that this updates this graphic when you look at this, and it basically gives you the way these are calculated. So if you multiply, or if you divide market cap by earnings, you can get the P ratio. You divide market cap by sales, you can get the PS ratio, and then you divide the market cap by book, you can get the PB ratio. Now for PEG-PEGI, I changed it. I combined this area with the calculator and this section. So here it's really cool. Now you have your existing current PEG and PEGI ratios, but you can also change these things to see what if, you know, what if this goes to $130 per share, which is, I'm just hypothetically talking about these things. That's what changes in the PE ratio, PEG ratios, and PEGI ratios. What if they go up to 3% dividend yield? PEG ratio goes down 0.82, and PEG ratio stays at 0.99. So next, I have Warrior Met Coal. I've talked about Warrior Met Coal a lot, so I'll just briefly mention that, you know, they have a new mine coming out next year, finishing it, and so they're going to reduce their capex spend and increase their production next year. It's just going to be a perfect storm of kind of the events that are happening, and they're going to increase their free cash flow yield compared to their market cap by many times. So it's a very targeted play into the future, and you can check out my other videos that I've had about them to get more details about their earnings and what they reported in the last earnings and the thesis behind why I still believe in Warrior Met Coal. And so I haven't added anything to the 442 shares I have so far, mainly because it went up. It was a great time to buy a few weeks ago when it hit $41, I believe. And congratulations to everybody who bought then, because that was an amazing time to buy. But since then, it's gone up to 50. It went up to 53 or something like that. So I'm going to let it play out and see if it drops again, which it definitely could. I'll pick up some more shares of that. So next up is BABA. And like last video, I said I started a tracker position, very small amount, maybe like it's around $115 right now. It's around $115 right now. But the price I got in at, it was 104.61, which is a pretty good price, I would say. China's gross domestic product, GDP, expanded 5.2%, which was better than analysts were expecting, of 5.1%. So not major growth, not a major beat, but it was higher. So all the Chinese ADRs rallied. BABA went from 104.6, where I bought it, to, I think it reached to $116, $117, and now it's pulled back a little bit. So looking at BABA through my software, it's converting all the numbers from CNY to USD. You can see that BABA has good free cash flow and good revenues. Their revenue has been increasing since 2017, probably even before that. Their net income is increasing since 2022, the major bear markets in 2022, EBITDA following that trend. Cash flow, you have to look at cash flow in terms of capex, obviously, because that tells you how much they're spending on data centers and chips and things like that to advance the AI overview and goals that they have for the company. Cash to debt, it's not bad. You'd see a breakdown of their expenses. They've been buying back a lot of shares, 2.72 billion in 2022, and now 2.41 billion in 2025. They still have a large number of shares outstanding, but they've been chopping that down with huge buybacks. And their dividend, they do pay a dividend, so that's nice. EPS going up and to the right. Super low PE. PEG and PEGI are super low. They're under 1, which is a great sign. You can see these are green. Estimated annual growth based on historical and analyst estimates, 17.15%, which is better than the market. And so yeah, you can see the PEG and PEGI ratios are good. Even they introduced a dividend a few years ago, 2023, and that helps out even more because you can look at the PEGI ratio and it's even lower. It's 0.87x, which is amazing. It's under 1. So you can see that the trends are going up and to the right. You know, their revenue is increasing, their EPS is increasing, their net income is increasing, free cash flow is strongly generated and being used for AI reinvestment and further growth of the company. Moving on, let's go to the last new addition, and this is an addition that I made today of ASML. And another tracker position, a slightly larger tracker position, just because I wanted to capture a good, just because I wanted to capture a good price for this. But not too crazy. I spent about $800 in buying about one share of ASML as a tracker position. And ASML has a lot going for it. And here, if we do some analysis first and then talk about the thesis afterwards. So looking at it through the software, it will convert all the Euro data to USD, which is great. This is a little delayed, but we're working on a real-time feed for this software as part of the beta updates. Looking at this, you can see a huge increase in revenue per share. From 2015 onwards, it's basically been up and to the right. The price has also been up and to the right, but with a lot of variation in between. So you can see in 2020, they went anywhere from 191 to 493. Here it's 489 to 900 basically. So a lot of variation in the year, intra-year, but overall it's going from up and to the right. EPS, same thing. You can see, generally speaking, it is up and to the right. This is what you want to see. Free cash flow per share, yep, same thing. And you just see a lot of good metrics and trends here. And let me know if you guys want me to color code this based on click. You can write in the comments below what other edits and updates you want to see in this software before I release it. I'm still working through the development process, like I said. Shareholder equity, getting higher and higher. And return on capital, return on equity. You see some huge years in here. 2021, 58%, 2023, 58.3%. 50%, 41%. They're making a lot of money selling these very complex $400, $500 million machines, lithography machines. These guys have a monopoly on this industry. Looking at the visual trends, you can see up and to the right for revenue, net income, EBITDA, free cash flow, 10 billion and 10.57 billion in 2024. We'll see what they are going to guide for in future quarters, but they just reported and they released, the reason for the drop is that they released a statement that said basically they cannot predict the growth, if they're going to have growth in 2026, just because of all the geopolitical and tariff drama and all that stuff. But this is a very strong monopolistic business, and I don't see any disruption as of yet. I haven't seen any disruption currently, so we just have to make sure that we look at that. But this is a very, very strong moat, like possibly the strongest moat that I've ever seen for a business. So right now it's still a great buy, and especially with the drop in the share price today, I wanted to take advantage of that and get that tracker position in. So you can see their expenses. Yep, they're making more cash flow than their expenses for sure. And then they have a dividend as well, which is really nice. They're thinking about the shareholders and investors, returning capital to them. They're buying back shares. So all of these metrics are showing me that this is a great company to invest in based on historical and past performance and how the management is treating shareholders and shareholder returns. Now let's look at the key metric valuation section. So this is on par with other, high growth, high tech names. So 32x for PE ratio, profitable. It's a profitable company, mature company. So yeah, this is the metric that we're going to use. So we're going to have to compare this relative valuation metric to, other high-tech, high-growth company PE ratios. PEG and PEGI ratios, it's slightly overvalued here if you were to just take these metrics, which obviously you would never just take one set of metrics, but slightly overvalued. So if it fell even more, and this doesn't take into account the drop today. So my cost basis was about 750. So it's a little bit even lower valuation that I got it at. So 1.37, 1.31x. But if they can sustain that growth, let's see what happens. So this is estimating a forward annual growth rate of 21%. And with that type of growth rate, we look at the fair value, and it's giving me a fair value of 1078, which is implying a 31.1% undervalue of the previous day's close, and it'll be even more with the current day drop. With a two-stage free cash flow to equity valuation model. So looking at the portfolio overall, the portfolio has gone up about almost 4% in 1 month, which is pretty good. And it was at 160,000 at the time of the last video, about 1 month ago. And now it's 166, close to 166,000. So pretty good gains. I'm looking for even bigger gains from these new positions that I've allocated some tracker positions to. So as dips happen and news cycle and hype cycles happen for these names, I'm going to see if the valuation matches what I'm willing to pay for it. I'll have one of these every month going forward around the middle of the month, just because I started with the middle of the month for the first one. So we'll see another portfolio update and see where how the portfolio is performing in about August 15th, 16th, around there. And hopefully it's up, but at that time I will go through my buys, and I usually don't sell anything unless it's egregiously overvalued and I need to take some chips off the table. But for now, I think all the plays are just gonna stay there, and I'm just gonna add as dips happen. Yeah, so thanks guys for joining me on this video, and like and subscribe, and I'll see you guys in the next one.